Mergers and acquisitions, often abbreviated as M&A, are significant events in the business world. These transactions can reshape industries, redefine competitive landscapes, and create new opportunities for growth and innovation. They involve the combination of two or more companies, which can be achieved through various methods and strategies. This can happen in several ways, each with its own set of advantages and challenges. One company might acquire another outright, absorbing its assets and operations, or they might merge into a new entity, combining their resources and capabilities. M&A activity is often a sign of a dynamic and evolving market, reflecting the constant search for competitive advantage and growth. It can lead to increased efficiency, innovation, and market share as companies leverage their combined strengths to achieve greater success. Understanding M&A is crucial for investors, managers, and anyone interested in the complexities of the business world. It provides insights into how companies grow, adapt, and compete in an ever-changing environment. Imagine two companies, each with their strengths and weaknesses, coming together to form a more robust and competitive entity. One company might excel in product development, bringing innovative products to market, while the other has a strong distribution network, ensuring those products reach customers efficiently. By combining their strengths through an M&A transaction, they can create a more competitive and successful enterprise, capable of achieving more than either could alone. Think of it like combining puzzle pieces to create a more complete and valuable picture, where each piece adds to the overall value and potential of the new entity. M&A deals can range in size from small private transactions to massive multi-billion-dollar deals that make headlines around the world, capturing the attention of investors, analysts, and the public. The reasons behind M&A are varied, but they often boil down to a desire for growth, increased profitability, or a strategic advantage in the marketplace. Companies may seek to expand their market presence, diversify their product offerings, or gain access to new technologies and expertise. Whether driven by a need to expand into new markets, acquire new technologies, or simply eliminate competition, M&A can have a profound impact on the companies involved and the industries in which they operate. These transactions can reshape competitive dynamics, create new market leaders, and drive innovation. However, M&A is not without risks. The process can be complex and fraught with challenges, requiring careful planning and execution. Integration challenges, cultural clashes, and overpayment for acquisitions are just a few of the potential pitfalls. Successfully navigating these issues requires a deep understanding of both the strategic and operational aspects of the transaction. That's why it's essential to approach M&A with a clear understanding of the complexities involved. Thorough due diligence, strategic alignment, and effective communication are key to achieving a successful outcome. This essay will delve into the details of M&A, exploring the different types, motivations, processes, and challenges, along with real-world examples to illustrate these concepts. By understanding the intricacies of M&A, you can better appreciate the strategic decisions that drive these transformative business events. Acquisitions can take various legal forms, each with its implications for the companies involved. Understanding these structures is crucial for making informed decisions. Let's explore some of the most common structures in detail. A merger is a complete combination of two or more companies into a single surviving entity. In a merger, the assets and liabilities of all merging companies are legally consolidated into the surviving company. This means that the new entity inherits all the rights and obligations of the original companies. This structure is often used when both companies are of similar size and want to combine their operations entirely. It can lead to significant synergies and efficiencies. In an asset purchase, the acquiring company buys specific assets from the target company, such as equipment, intellectual property, or customer lists. This allows the acquiring company to pick and choose the assets it wants. The acquiring company does not assume the target company's liabilities in this structure, making it a less risky option. This can be particularly advantageous if the target company has significant debts or legal issues. In a stock purchase, the acquiring company buys the outstanding shares of the target company from its shareholders. This method is often used when the acquiring company wants to take over the entire business. This gives the acquiring company control of the target company's assets, liabilities, and operations. It essentially steps into the shoes of the previous shareholders. Stock purchases are common when the acquiring company wants to gain control of the target company's entire business. This method can be quicker and simpler than other forms of acquisition. A triangular merger involves the creation of a subsidiary by the acquiring company, which then merges with the target company. This structure can be particularly useful for tax planning and liability management. This structure can offer tax advantages and limit the acquiring company's liability. It allows the parent company to isolate the target company's liabilities within the subsidiary. A reverse merger occurs when a private company acquires a public company. This is often done to gain access to public markets. This allows the private company to go public without going through the traditional initial public offering process. It can be a faster and less expensive way to become a publicly traded company. Each of these structures has its own set of advantages and challenges. The choice of structure depends on various factors, including the size and nature of the companies involved, their strategic goals, and the regulatory environment. Understanding these different legal structures is essential for anyone involved in corporate acquisitions. It helps in making informed decisions that align with the long-term objectives of the business. By carefully considering the implications of each structure, companies can navigate the complex landscape of acquisitions more effectively and achieve their strategic goals. M&A transactions can be classified into different types based on the relationship between the companies involved. A horizontal merger involves two companies operating in the same industry and often competing directly. For example, the merger of two major airlines would be a horizontal merger. A vertical merger involves companies at different stages of the same supply chain. For instance, a car manufacturer acquiring a tire manufacturer would be a vertical merger. A conglomerate merger involves companies operating in unrelated industries. This type of merger is less common today than in the past and is often driven by a desire for diversification or to acquire undervalued assets. Each type of merger has its own strategic rationale and potential benefits and drawbacks. Understanding these distinctions is crucial for analyzing the potential success of an M&A transaction. Section 4. Motivations driving M&A activity. Companies pursue M&A for various reasons, each with its own set of potential benefits. These motivations can range from strategic growth to financial gains, and understanding them is crucial for any business looking to engage in such activities. Here are some of the most common motivations that drive companies to consider mergers and acquisitions. Growth. M&A can be a fast track to growth, allowing companies to expand their market share, product offerings, or geographic reach more rapidly than organic growth might allow. This can be particularly beneficial for companies looking to enter new markets or enhance their competitive position. Synergy. Synergy refers to the idea that the combined value of two companies is greater than the sum of their individual parts. This can be achieved through cost savings, increased revenues, or a combination of both. For instance, merging companies might streamline operations, reduce redundancies, or leverage each other's strengths to create a more efficient and profitable entity. This can be achieved through cost savings, increased revenues, or a combination of both. Synergies can also come from enhanced technological capabilities, improved market access, or better resource allocation. Diversification. M&A can help companies diversify their business portfolios, reducing their dependence on a single product, market, or industry. This diversification can provide a buffer against market volatility and economic downturns, ensuring more stable revenue streams. This can be particularly attractive in cyclical or volatile industries. By spreading their risks across different sectors, companies can better manage uncertainties and enhance their long-term sustainability. Defense strategy. In some cases, companies engage in M&A as a defensive strategy to prevent themselves from being acquired by a competitor or to gain a competitive advantage in the marketplace. This can involve acquiring key technologies, talent, or market positions that would otherwise be vulnerable to competitive threats. Ultimately, the motivations driving M&A activity are multifaceted and complex, reflecting the diverse goals and challenges faced by businesses in today's dynamic market environment. Understanding these motivations can help companies make informed decisions and achieve their strategic objectives. Section 5. The M&A process, a step-by-step guide. The M&A process is a complex and multifaceted undertaking that typically involves several distinct stages. 1. Identifying targets. The process begins with identifying potential acquisition targets that align with the acquiring company's strategic objectives. 2. Valuation. Once potential targets are identified, the next step is to determine their fair market value. This involves analyzing financial statements, market data, and other relevant information. 3. Negotiation. With a valuation in hand, the acquiring company can initiate negotiations with the target company. This stage involves reaching an agreement on the terms of the transaction, including the purchase price and the structure of the deal. 4. Due diligence. Before finalizing the transaction, the acquiring company conducts due diligence to verify the target company's financial health, legal compliance, and other material information.